Most investors think the only way to increase income is to increase risk, higher yield, higher volatility, more aggressive assets, but that's not always true. And chasing yield blindly can actually increase fragility. Good morning. Today we're talking about how to increase income without increasing risk, because income matters, especially if you are approaching retirement or planning for financial independence, but there's a difference between increasing income intelligently and stretching for yield. Here's the problem. When investors want more income, they often jump into high yield dividend stocks, shoe risky REITs, leveraged income funds suit exotic strategies. They don't fully understand the yield looks attractive. But yield alone doesn't equal safety. Here's the midpoint truth. If something pays significantly more than the market average, it usually carries higher risk. So how do you increase income without stretching too far? Let's break it down, reallocate within structure. Sometimes income increases by shifting allocation, not increasing risk. For example, reducing overweight growth, slightly adding diversified dividend ETFs, adding modest bond exposure. You're not increasing total risk. You're redistributing exposure. That can increase income flow while maintaining balance. Focus on quality, not yield. There's a big difference between high yield and reliable yield. Quality dividend payers with strong cash flow and sustainable payout ratios are more durable than high yield companies struggling to support payments. Income should be stable, not dramatic. Layer, don't replace instead of replacing your entire growth allocation with income assets. Layer income on top gradually. For example, keep growth core intact, add small income sleeve. Rebalance periodically. This preserves growth potential while increasing cash flow stability. Control concentration. Income portfolios can become concentrated fast. Utilities. Energy. REIT heavy allocations. Sector concentration increases risk. Diversify income across sectors and asset types. Match income to timeline. If you don't need income, now don't overprioritize it. If you do need income soon, structure it intentionally. Income should support a goal, not just satisfy a desire for cash flow. Now let me ask you something. Is your current income strategy intentional or reactive? Because chasing yield during volatility often leads to disappointment. Here's the final truth. Increasing income safely requires structure, not urgency. You don't need the highest yield. You need sustainable yield. Durability beats excitement. A balanced portfolio can increase income gradually while protecting long-term compounding. And compounding still matters, even when income becomes important. If this helped you rethink how you approach income, subscribe, because here we build income without fragility.